Hi everyone. First of all, Happy New Year. I hope this year will be great for each and every one of you. What a start of a year. I'm really excited to hear what others are thinking, and I see quite a few interesting signals in the market. But yeah. I'm sure the beginning of 2025 is not what most people expected. So yeah, let's dig in. So maybe Ted, what's going on? What do you see in the markets, and what can we expect?
Yeah, so hey, good to see you guys, and thanks for having me back. I think it's been 6 weeks or so since I've been on. So let me share some thoughts. Share my screen. Bear with me while I start this up. Great graphic, by the way. Let's see. All right, so embrace the chop. So what I wanted to chat about was some 2025 macro themes, sort of as I took some time off over the holidays, just thought about 10 key points, 10 key drivers for macro in the year ahead. Want to do a little bit of a short focus on the Fed and bonds, which have been at odds for over a year now. Talk briefly about the new macro regime that we find ourselves in, look at some signals, and then chat about some trades. So these are the themes that I put out at the beginning of the year. You can see it on my profile at tdarling1 on X. And I really want to talk about the first two items. So the items that I saw this year as the sort of key drivers were the Fed and bond market at odds. I'm going to break that out. The bear steepener that's in play right now with the de-inversion of the 10-year 3-month. We've got ongoing sticky U.S. inflation above trend, normalized nominal gross domestic product. We have employment weakening a little bit around the edges, although that's arguable since the first of the year. We have central banks cutting, with the U.S. likely on pause. I'm looking forward to the yen carry trade unwind round two, which I think is not far away. I think the Bank of Japan's hands being forced here, and with yields going up across the curve. We've got China trying to stimulate, but constrained a little bit by a strong dollar. We got global conflicts that have been increasing. Maybe it gets resolved. Some of these conflicts get resolved, but right now it doesn't seem good. Trump presidency, who knows? We've got a lot of stuff going on: tariffs, taxes, budget deficits, debt ceilings. Too much to talk about today. And then, of course, we have U.S. Dollar strength, elevated yields, and then, of course, SPX and BTC. Are they topping? What are they doing? At the end of the year, definitely we had giddy sentiment. So I'm going to break out the first two. So what we saw, what we've seen is this strong TNX as a proxy for the 10-year bond. What we've seen since FOMC cut back in 9/18, we've tracked this over a period of time, talked about it the last few times I was on. We basically had yields turn around as soon as the Fed cut 50 basis points and go higher. We've had, made a fresh high. I actually got long bonds in here when this thing came down. We had a little bit of a buy signal and got stopped out as we went along. But we basically got this ongoing yield strength that continues to manifest in the U.S. and really across the world. And this has been going on for a while. We've got the Fed and the bond market basically at odds. This is a weekly chart. If you go back to October of 2023, we had bonds. This is the cycle high. We hit almost 5% in the 10-year. And if you remember the conversation, there was a lot of pressure at the time for the Fed to start cutting rates. So in this October timeframe, cut, we got to cut. And so the bond market, as the economy slowed, started to cut rates for the Fed. And if you remember, at the end of December of 2023, the Fed said, yep, it's time for us to start switching. It's time for us to start maybe looking at reducing short-term rates. And what did the bond market do? It immediately spent 4 months, went to the top of the range, went to 4.7%. Fed never cut during this period of time. And so here you got in anticipation, if you remember, the Fed funds we were pricing in about 6 or 7 cuts at the end of 2023. And as soon as that got built into the short end of the market, the long end went higher. And such that by the middle of the summer, we had that growth scare. And you remember, basically coming into the summer and the fall, the Fed panicked. They saw the SOM rule violated. A lot of us looked at that, saw, hey, maybe recession's on the table. They cut, right? And so you've had this is where the Fed cut, and again, the bond market goes nuts. So there's this sort of back and forth between the bond market and the Fed. And so here we are again, we're in a tightening financial conditions state with the 10-year. We got the Fed trying to loosen. Now the Fed's on pause, likely. And we're likely, as a result, looking at a softer economy again as we head into Q1. That's my going-in assumption. At the same time, with this bear steepener, basically bear steepeners where the long end rises more quickly than the short end. This is a long-term chart of the 10-year, 3-month 10-year, 3-month yield curve. And what we've seen every time after this is over time, as the curve inverts, about 3 to 6 months afterwards, they determine there's a measured recession. A lot of people have thrown this indicator away and said it doesn't work anymore. And the reason for that is that we were in a 2-year period of time where we had this was over 2 years of time where we were inverted 10-year, 3-month. Now we've reinverted. Nobody's talking about it anymore. I think it's in play. I think we get a softening. I think we're going to get at least, if not a recession, some softness as we make our way at the end of Q1 and into Q2. All right. So that's just a sort of backdrop for the presentation. Where are we now in terms of the macro regime? I have us, and the macro service that I use has us in what they call an inflation regime, which is not dissimilar to stagflation. So growth down, inflation up. I think that's what the market's pricing. We've seen commodities basically rip. We'll talk about this a little further. In terms of the actual economic regime, I don't think we're really there yet. I think we're more in a stable growth environment currently. At least it hasn't manifested. This is the most recent Atlanta Fed real-time nowcast. We ended Q3 rather at 2.8%. Most recent Atlanta Fed has us at 2.7%. So you could say growth is stable, still growing, not seeing that contraction yet. But that's clearly, in my view, what is being priced by the market. Today we had the NFIB small business sentiment survey come out, and this has been just a ripper. So we went 105. This is small businesses, how they feel about the future. This is all driven by the small business owner excitement around what the Trump presidency represents. And so we've had a huge move in this. I think this is sort of a measure of animal spirits. Small business probably accounts for 50% of business in the US. So it's an important indicator. It's just something to watch. Today we had producer prices out. They were up 3.3%. This was slightly below expectations. So we had a fairly stable market response, both in bonds as well as in major equity indices. This is sort of a forecast for what's ahead for inflation tomorrow. We have CPI print here in the US. I think CPI comes out tomorrow in the UK as well. We have seen a troughing and tick back up of inflation. So this is the November report. We're plus 2.7%. Projections, this is core. Core was kind of flatlined at 3.3% in November. And what we're seeing for projections, I'll look at this first one down below. This is the Wall Street Journal. Their median forecast is plus 2.9% CPI and plus 3.3% core. This is a chart I've shared over time, which is the Cleveland Fed. Their nowcast has us rising to 2.86%, call it 2.9 and 3.3%. So this seems to be consensus. I think it depends. I think market response will depend where we are with respect to consensus. I don't think PPI was really a good indicator for what's to come. But anyway, we do clearly have an uptick in inflation, and we have flattening growth, and the market's starting to price. An inflationary, stagflationary environment. From a market signals point of view, the other thing that happened is the dollar turned tail at the FOMC meeting. This is that same 4-month chart. This was the FOMC meeting, and basically the dollar put in a bottom counterintuitively. I mean, the Fed loosened, the dollar should theoretically have gone down, but we know that the bond market tightened while the Fed was cutting, and we've seen this 10% rise over 4 months in the dollar, and that's been raising havoc with international and emerging markets, certainly, and starting to cause some concerns in our own market. We also have yields nearing, I just talked about this, yields nearing the 2023 highs. Recall that was about just under 5%. It's really, the yields are getting to be fair value in my view. There's been a lot of talk about this, what are they calling it? This term premia that we never discussed before when the curve was inverted, but now we've got a pretty decent term premia. I think this is getting interesting, and I've started to try to play the top, which is costing me some money, but we'll see. The other thing is, and this is a trend that I've managed to catch, is CRB breaking out. So this is a weekly chart of the Commodity Research Board index at end of last week, and you can see that I actually tried to get long commodities throughout this period of time. I got chopped up, but it seems like we've got a clear sort of move to a fresh high over the past 2 years. And so that is definitely part of how I'm positioning. The other question is, and I didn't see where the VIX closed yesterday, the VIX was pricing bullish trend in my work, and I think in my fractal range work as well is looking bullish. And so we'll see, but the VIX is looking bullish. And with I have SPX trading neutral at this point in time. I have IWM in the bearish camp, and so really some trouble potentially for equities here in Q1. So how am I positioned? So right now I'm long dollar via UUP. I'm long commodities, PDBC, PDBA, XLE, gold. I got stopped out at the end of middle of December, and then I just got back in recently with a good weekly signal. I'm long trend, which is CTA. I got long this week, IVOL, which is a steepener play, which has been dog meat during this whole steepening curve, but I've got some positive signals there. And then I've got a high allocation to USFR and bills. I was as high as 85%. I'm now about 65%, I think. And I'm also, during this kind of period of time where we have a lot of chop going on, I've been taking some tactical longs and shorts with option spreads. So let me share a little bit about what I'm looking at from share that again. Let me take a look, share with you some of the trades. So where I wanted to start was with the dollar. This is UUP. I had a signal on the weekly chart, which I use to help kind of get me long counter trend positions. I often will do small positions and I'll often hedge. I did get long in the fall here. I had this period of time where my trailing stops got me out, but I had, as you know, I've talked about my stops hit, it's 4 stops and I'm totally out, but I take it a day at a time. And I actually had about a quarter of my position managed to avoid the stop, so I stayed long. And then when my signal went positive again, I got long here. I added on the pullback. This was January 6th. I'm expecting we're going to see another pullback here. I'd be interested to see what Raphael has to say about the dollar. But so far as I'm concerned, it's bullish trend and I'm buying pullbacks. Again, a weekly chart. This is PDBC. So this is a commodity, broad commodity index. Had a signal on my weekly chart towards the latter part of December, last week of December. Got long this position here, caught a lucky break, and it has broken higher. I say it's a lucky break in that, I have about a 2% position. I want a 4% position. I struggle when stuff gaps to add to add to positions. So I'm really waiting for a pullback to start to add to PDBC. PDBA is agricultural commodities. This has been a core position for a long time. A very similar situation. Ended up getting stopped out of a core position here when my weekly trend broke. Trailing stop was hit. But no, I wasn't totally out, and I was able to add when I got a better signal. So here's where I added. I added here. I sold a little bit here, trying to trade around the position a little bit because it's in my trading account. This is actually my biggest position right now. It's an 8% position other than cash. I added last week on this pullback to a low end of the range, and still think this maybe has some room. We're clearly consolidating here. I'm not a buyer. I've got a full position. I'd like to see this continue to move higher along with other commodities. XLE is another one where I think I said Raphael a chart. I don't know when it was. It was probably here where this thing broke out. XLE broke out. I said this thing's got a measured move to 110. I immediately got stopped out like a week later. This thing went straight down. I actually managed it with put options. I had a small core position that when I got my signal the week of, again, the end of the year, I've added back into the position. I got added here. I added here. And now I've took a little bit off the table yesterday because it was at the top of the range. Volatility has been relatively high, and so it's constraining my position, but I've got about a 3% position on an XLE right now. Gold is another one. I got stopped out of gold. This chop got me stopped out. I have fairly tight trailing stops, and so I got chopped out of a position. I was totally out at the end of the year. I got a signal that maybe it was time to get back in. I did buy at the end of last week. It's a new position. We'll see. This is kind of touch and go, but it should perform well in what I think the environment that we're in. So we'll see. We're looking for a break out of that range. CTA is another position that it's been a core position over a period of time. It is simplify managed futures strategy. It's basically trend following. It's a lot of short bonds, frankly. And so this is a position that I've had. You can see I get a lot of chop in this thing. And so it kind of buffets me back and forth. But what I've done is I've held a core position over time. And then as I get a positive signal, I've added. So I added some here. I added some here. Still getting some positive price momentum. Probably should take some off here. It does tend to mean revert. But as it comes back to the middle of the range, I'm going to want to be a buyer of CTA. IVOL. I mean, this has been my, this is interest rate volatility, but it's basically a play on the steepener. I've been watching this thing like a hawk. I mean, here we have the curve steepening, both the 10-month, 3-month, 10-month, 10-year, 3-month, as well as the 2-year, 10-year steepening. And I've got nothing but chop out of this thing, downtrend, didn't turn around. Last week I got a signal, I put on a position. So I got long here. This thing kind of pulled right back. I thought, geez, I'm not going to be long to this one, but it has turned around the last couple of days. And we'll see if it can break out of this sort of range. It doesn't merit a large position because it's still bearish trend, but it does get me into a position that I can start to manage. I can start to build if it does start to trend. All right. And then I have 2 tactical trades I want to talk about. This is SPX. I trade it, I'm sorry, it's SPY. I trade it through SPY. And I put on a position yesterday. This thing kind of stabilized at the low end of the range. This was something where I thought I might be able to get long. It did flip neutral trend in my book. What I did is I put on a 580 by 590. So I'm basically trying to play this little range call spread. I did a call spread because vol was relatively high. I think it had a 16 implied vol, and both. This is a March expiration, so I have a position on right now. I didn't know today whether we were going to get this thing to turn around, or if it was going to close positive or negative. It spent the whole day chopping around. I'm still holding on. I'm hopeful for I have a position on. I'll get out if it takes out this low, but I do have that position on right now. And then finally, this has been a tough one. This is TLT. It's, last week, the level of bond bearishness is just everybody pounding on bonds. Everybody saying this thing's going higher forever. I just So ahead of payroll, I put on a call spread. This was payroll over here. I put the position on here. On the 8th, that was Wednesday, we had the day off here for Jimmy Carter's memorial service. I put on the position here as an, I believe it's 85 by 88 call spread. I expected that the payrolls may be weak. I didn't get the weakness. I immediately took the half of that position off. I'm still holding the position, but it's not long for this world. I'm cautiously optimistic. I'll buy a break tomorrow after CPI is printed, but if not, I'll close that position out and take my lumps. So that's where I am right now, and that's what I'm thinking about.
Thank you, Raphael. So bullish, bearish.
Hey guys, Happy New Year. So it's been more than a month since the last show. But yeah, we French like our holidays. So so yeah, overall now I'm neutral equities. So if you remember on our last show, I already didn't have any long equity positions. I had sold them end of November. The reasons were that one, I had sell signals on NQ, ES, I had buy on VIX, so that was for the signal. Also, you had Hearst, the 3 months that were decreasing, telling us that the strength of the trend was getting weaker and weaker. And on top of that, the guys I pay for macro were saying that the macro outlook for the next few months was not looking good. So it looked like a good call, especially considering where we are now. The only position I had at the time left, sorry, was gold. But I got stopped out on this one. We had a quick dip, I think, for maybe 2 days below 2,600. So I got stopped out on JC on this one. So thus far I've been day trading and no swing positions yet. So I'm gonna go over to the charts and let's see what I see. Okay, give me a sec to adjust. Okay, I'm good. So let's go with ES first. So the sales were here. And so what's happening currently is ES I've been trying to break trend. We've seen that also in NQ. We've seen that in crypto. We've seen that in the Russell, and I'm going to show you also in some tech stocks. So we are definitely encountering some weaknesses. Now the problem is I'm starting to get some oversold signal on equities, and the bearishness is getting very hyped. I looked before the show at the implied volatility premia on equities, and they are insane. So my current thinking is that there is a risk to get some kind of pop. I would guess into the CPI data after the CPI data. So my expectation would be that we should get a retest at least of trade here, volatility trade before we could get a continuation of the downtrend. So that is my expectation for ES. I would be glad to get some kind of dip into 5,700 in Q1. But I want to wait for what happens after they unleash their hedges after CPI. So I want to see this pop to trade, and I want to see what happens after. Do we reclaim trend, MFR trend, or do we stop, just go flat, and then the sell-off continue. I will make my assessment after the CPI data is released and after the hedges get unwound. But overall, you can see here volatility is high. Trade is trading higher. This is the white line here. I mean, it's not good to be long right now. I mean, they are trying to do some bottom searching. I think it's a bit risky currently, especially considering the macro outlook. And now something surprising, we are joking about it, but not surprising. It's Germany in Europe still holding a bullish trend. I mean, this thing just never disappoint. When in doubt, just buy Germany. Anytime they test trend, it's a place to buy. Now let's go to Nikkei. In the previous show, I mentioned that I was looking for Nikkei to actually switch trend. It had been several months with Nikkei into what I called at the time chop, and I was looking for. Sorry, my background is black. Everything is written in black, so you will not see. I didn't have time to adjust. But the idea was here, after the confirmation of trend, to wait for trade and trend to cross and to buy on the next retest of trade. So I didn't do, considering my thinking about equities, but the idea would have been to buy here and to get the transition with confirmation to bullish trend. So far, it has been quite disappointing. We have been in a sell-off for the past few days, and the trend is back to neutral. It doesn't seem that the move I was expecting for Nikkei is about to materialize. So if you took that trade, the one I mentioned in the last show, I would consider maybe stepping back and be quite careful here. Now let's go to DXY. So we switched bullish on DXY. I think it was in October. Yeah, it was in okay. On October, we switched to bullish trend in DXY, and we have been experiencing a very, very bullish trend on it indeed. Now the thing is, so you know how I like to map the minimum value of trade historically to know where the trade of volatility of an asset may go to before we get some kind of pop involved. So we are currently, so this is here, value is around 1. We are currently at the mean value of trade for the vola trade of DXY. So my expectation currently would be that this nice uptrend move that we've experienced in DXY should mark a pause. And then we'll see. Will trade of volatility continue to go down, or we will start to see some volatile action in the dollar. My expectation would be that we're going to start to see some volatility in the dollar. Another reason why I'm saying that is because when you go to the overview page on DXY on MFR, you can see that the I checked it before. Yeah, sorry, it was there. The horse value of DXY on the 3-month basis is going down. So we were in the high 0.70s in November because I marked it. 30 days ago, we started to go down. 15 days ago, we went even lower, and now we are maybe about to cross the 0.6 value. So this means that the trend in the dollar is weakening. So considering what I just said regarding trade arriving at its minimum value, my expectation would be that we will see some volatility in the dollar. So Ted, you mentioned you were long the dollar. I would consider monitoring volatility for this asset. Now for VIX. So the problem with taking a bearish bet on equities is that to do so, I need to see VIX trending. I need to see VIX transitioning to bullish trend. And you know the steps I use for VIX. I need to see price above trade and trend, volatility, trade and trend, so red and white. I need to see trade cross trend. We don't have that. And I need to see the retest of trade. So for now, I have a big issue taking a bearish bet. This is why also I'm saying I'm neutral. I'm not bearish. I'm neutral. Here we have elevated volatility. This is the blue line, elevated volatility, but we don't have the setup for a huge VIX explosion. So best bet would be volatile assets, so ups and downs. We keep doing chop, but until we get the setup for VIX that you know, I mentioned this repeatedly in almost every show. I don't see a big sell-off happening in equities. Now, one interesting asset, and Raghav actually mentioned it. I think it was in the last show of the year. Last year was he was talking about he was monitoring oil, maybe transitioning to bullish trend, and I actually missed it because I was just not looking at it. But he did see that, and if you monitor the trade and trend script, you saw that trade and trend crossed actually on the Christmas Eve or the day after Christmas here. So you could have taken a bullish bet here. You got a confirmation on MFR. So I'm going to show you USO. You can see that at the beginning of this year, we got the confirmation on MFR that trend had shifted. So let me check here. Here, 2nd of January. So USO shifted from neutral to bullish. The first change was December 11th, bearish to neutral. But you got the confirmation from trade and trend script here. So if you took the bet on CL, that was nice. I don't have sorry, we don't have, I don't think we're going to top soon. The main reason is, sorry, I'm turning it to white so you can see. The main reason is the mean. Sorry, I just turned the text instead of the mean daily trade value is much lower. It's around 3.9, something like that. If you want to mark it, if you are using my script, we have room. Volatility has room to go down. So I'm not going to say this is going to be like we're going to go like Bitcoin, but I would expect any dip to be bought until trade is in this vicinity. Okay, so we are. I guess oil being bullish is with us for some weeks, maybe more than that. So monitor this volatility trade. So I mentioned that gold was my last position I had end of the year and got stopped out. So basically the issue, the mistake I made was, so I bought on the buy signal here. So you guys have access to my script, so you know that it triggered. But the problem is I had it there, and I put my stop at 2,600, and I got stopped on that day for, I don't know, 0 point something. But the problem was we broke trend. We confirmed the break of trend, and I decided to wait instead of re-entering. So currently gold is neutral. Volatility is still very elevated. You can see here. I'm sorry, the background is black. Next show it's going to be white, but volatility is very elevated. Another problem is I always look at silver and platinum before considering a position in gold, and silver is unable to reclaim a trend. It tried here, got smacked down. Now volatility is still rising. Sure, you have trade and trend moving down, but I need to see more than that. MFR trend is quite higher. So that's another clue for me that maybe buying gold, not yet. Platinum, I'm going to show you. Platinum here, rejecting trend again. So not good for precious metals, I would say. Now let's go to Bitcoin. So my view for Bitcoin is basically the same as for equities. I'm neutral. I don't want to take a position until the macro gets at least resolved. I mean, it's very hard for me to be bullish Bitcoin with yields where they are currently, and with potentially growth being impacted by yields. So I need to see Bitcoin much lower before being interested. Another thing that happened also for Bitcoin was it's trying to break trend. It's definitely trying to break trend. Ethereum, the other one I watch, already broke trend. I tweeted this one. It was here. So it should be the 9th of January. Yeah, 9th of January. And you see it plain as day, right? We broke trend, volatility is rising. So, I mean, the setup looks nothing like what we had in beginning of November when we entered cryptos. We've trade above trend, price retesting trade, and then we have beautiful volatility profile. We are below trend. We have trade crashing down, volatility increasing. I mean, there's no way I'm touching this one before I get at least a buy signal on the buy the fucking deep script. Now, sorry, I'm going to try to accelerate. Now yields. So yields, you know, we had foreseen the change of trend several months before all the fools on Twitter. So so far, very bullish, very bullish. I'm not gonna go into the discussion with steepener, etc. Just focusing on the signal. Very bullish. I mean, I think we still have room to go. I mean, it's not over, yields are not overbought, so I'm using yields, but you can think bonds inverse, right? But very bullish. People have been trying to buy this dip so damn hard for the past few months. I see no reason yet. So maybe there would be some clues. You guys, if you are using my script, you can check maybe on the daily the trade level and see if there is some historical low that we are approaching. But so far, I'm not seeing it. So same, I'm gonna wait, and I'm gonna watch very carefully the correlation between bonds and stocks, considering that I don't see any top in yields yet. Something also very interesting happened. It was NVIDIA, Microsoft, and Apple broke trend. So you had NVIDIA broke trend. Let's see. I didn't mark the day. Yeah, that was last Friday. So we need to see confirmation, right? But it broke trend. And I'm seeing all the option guys on the Twitter trying to buy this thing that's so damn hard. And now I'm seeing NVIDIA breaking trend. If this thing confirms, it's going to be a bloodbath for them. Microsoft looks the same. break of trend, and finally, you can see, yeah, nice break of trend, and the last one, Apple. I just want you to check the tickers that could be impacting the market overall. I mean, these things, they are breaking down, and I don't think it's something to be dismissed. Here, Apple is the same. So something to note, something to worry about, I would say. Okay, I have finished. I will stop the share. Sorry for being so long.
Thank you, Raphael. Great insights. And also, yeah, when it comes to yields, my opinion is first, let's wait for 10 years to go to at least 5%, then we'll see what's next. But for now, yeah, it's definitely, I don't see them stopping. And I watch gilt yields in the UK every single day, and it's crazy also. And it's hurting them a lot more than the US, of course. So it's very interesting. Even in Japan, even though we're talking like 1.2% on a 10-year, but still the trends across the globe in yields are very clear. They are going up, and we'll see very interesting tendency. Okay, so I'll share my screen, and actually in the end of December, I saw some interesting signals, and by interesting signals, I mean that it's not that often when a lot of things align at the same time. So I hope that it will also be a good opportunity to repeat again how I use my fractal range process and all the data points in there. But yeah, first of all, I want to start with this visualization of average sector correlations with SPY. It's just a three-dimensional visualization. So we see not only the historical average correlations for some one period, but basically across all the periods, all the way from 1 day to 180 days. So this blue thingy, I know that it's not that easy to see, but basically this blue thingy here, basically we have all the way from like 15-day back to zeros, basically is quite high, which is from 0.8 to above. And in the correlation dashboard, we will see that. And it happened in the peak was in December 31st, but of course the overall trend up was happening from very low levels since the middle of December, which is of course normal because there are 2 points to note. That one is that average sector correlations is not expected to go to negative, so I tend to think about it not in a way you would normally think about correlation, which is from -1 to 1. When it comes to average sector correlation, I tend to think of it more like 0 to 1, because having it in negative values is not really expected. But yeah, basically what happened on a 10-day basis, we saw values of 0.9%. 0.9% for average sector correlation was really high value, and it was expected that these average sector correlations will go down. Of course, then usually what it means when these average correlations are high is that overall market is pretty crowded. It means basically all stocks in all sectors in S&P 500 are basically moving to one direction. And in this case, actually, this was a end-of-year sell-off that made this happen. Of course, for me, it's quite funny to call that thing a sell-off, but hey, CNBC had markets in turmoil. It means it's a sell-off. So yeah, we had this couple percent drop, but actually that drop was pretty well concentrated because basically all sectors went down. So yeah, so first sign was that I expected, okay, so correlations should go down, but now what it will mean for the market, because of course the overall market can go up while some sectors can go down, or vice versa, and correlation doesn't mean some directional activity in the market. It can be anything. But what's interesting for me that when I see deltas in 5-day deltas and 10-day correlations, for example. So no surprise, but after such peak, basically almost all sector correlations to the SPY are going down, apart from XLP and REITs in a way. But again, I tend to look at XLU and XLU trend and our conversation about the possible end in the rotation to defensives was correct. That's exactly what happened. But yeah, I tend to go to XLU first because I find it very useful. But today, actually, it's very interesting. Now, XLU has a correlation to SPY of approximately 0.24. Yesterday, we had it testing once again the low end of regular term range. And we see today we had quite a strong day. So, of course, we have a bullish trend. And when it comes to probabilities, I think that way more probable scenario would be to that it will reverse back down when it reaches somewhere closer to the top of the regular range. But we'll see. What I want to see is will it remain bearish and will it or will it reclaim neutral and then bullish, and maybe we will go back to the defensives, and maybe defensives will be in fashion again. So first about the overall correlation. So now, of course, for people who are watching us, following us on Twitter, and even for our subscribers, of course, the main question will be, hey, why you are always showing this average sector correlations, but it's not available on NFR. And so for those who are not using that, we have one script which actually doesn't require any subscriptions. It's free for everyone. I believe you can simply go to my fractal range profile on TradingView and find it, but basically it's exactly what it is. It's average sector correlation to SPY. So of course it's not a three-dimensional views, but you can change periods and you see. And here you will be able to see that. So yeah, of course, when it goes up, it's a lot easier to interpret because yeah, it was 0.9 and it cannot go more than 1. And actually it will not go to 1 in most cases unless you are using very, very short periods like 2 days or something like that, which I don't use. But yeah, so first of all, I highly encourage you to use that. It's free, nothing proprietary about that. It literally takes correlations of each sector to SPY, sums them up, and divides them by the number of sectors. But for me, it's a very powerful tool, and I encourage you to start using that. So yeah, now let's go back to correlation. I saw on Twitter that people are talking about stock bond correlations, and even I believe there was a question, can we talk about that? But actually, stock bond correlations are not that interesting. Stock dollar correlations are way more interesting. And now, when it comes to I'll start, of course, from stock bond correlations, but on a 10-day basis, as an example, it's almost neutral. We had them grind quite high, which again added to the picture that I saw in the end of December, with average sector correlations going to very high levels, and at the same time stock bond correlation going to relatively high levels as well. That something is cooking, and yeah, we saw what. Again, the main reason why I'm not tweeting something like daily trades or daily views about markets or so on. I know Raphael is doing a really great job and Ted is doing a really great job in that. But I still believe that my main goal is to very openly teach you about the tools, and my goal is to help you be able to see things yourselves and not just with, hey, correlations are here, buy that, correlations are low, sell that. So yeah, that's why I'm sure some people notice that I tend to talk about same things over and over, because I still see a lot of questions about that, so I know that I need to do that. But yeah, so maybe it will help to take the entire process together and to see the whole picture. So stock-bond correlations, when they are when we are positive, it's actually bad for risk in the market. Again, it's bad for stock bulls and for bond bulls and so on, because even though we are in this regime from maybe 4 or even 5-ish years, but still from the market's perspective and portfolio perspective in general, it's not what you want to see, stock bond correlation positive. But again, like I said, it's not what really draws my attention now. Stock dollar correlations are way more important. Now, and Raphael actually made a very good point about the Hurst exponent of dollar itself, and we'll take a look at the chart a bit sooner, but basically this stock and dollar correlation, which is at these levels in the short run, yeah, so we had this drastic move down. Of course, now we have this bounce up, but correlations are still negative. So watch the dollar and watch the yields. Now, I would say watch the dollar first, and yields should be the second one in your watch list, because now this trade is about the dollar. So if correlations remain where they are, basically what you want to see is dollar at least stopping, maybe not stopping, but pausing this bull run if you want stocks, S&P 500 in particular, to have an easier time. But for now, we don't see that. I will change the time frame, because it's very easy, of course, to cherry pick one time frame and take a look at that. So yeah, stock bond correlations on a bit longer time frame are positive. So keep that in mind, and they want to go quite higher, at least that's what I see. So yeah, and it's not good for bulls either. Yeah, so these were the correlation related signals that I saw, and also the deltas. Yeah, so as you can see, basically XLP correlations are going up with a SPY on both 10 days and 20 days. So maybe that will help you. But yeah, now let's go to the futures, and why I think that a couple of days ago we had this very, very important thing happened, and fortunately for now it didn't, sorry, it failed. So yeah, I'll talk about that. So you know that when it comes to futures, I watch some levels that, in my opinion, are very important, and that markets have memory, of course, and these levels are important not only now, but these levels will be important years after now, and old levels are also important. So I use a couple of things. So first of all, of course, the settlement prices, and when we had this move down and the market went bearish even for a while, but what was happening? Basically, one close of 10 of December was 58.66 when we had this dodgy candle, and this dodgy candle is actually very important, not because of some price formations or technical analysis. I don't use candle formations, but what it meant that the low of this candle was 58.09, and now if we go to December contract of 2024, I already showed this thing. For those who want to see last settlement prices of contracts, here's how you do it. And of course, because contract is expired, TradingView tells that symbol doesn't exist. But if you press enter, it exists, of course. So yeah, and the last settlement price was 58.40. And last settlement prices of each contract, I always have them written down. And I have them all the way back to like 10 years ago. So, I mean, I have levels for when S&P was costing like 1,300 or something. Just to have them because they are pretty important. But anyway, so first level, December settlement level. My thinking was this. Okay, now it's starting to get interesting. If we, let's go back now to the main contract. If we go and close below 58.40, then it will be a very, very bearish signal and confirmation, and I will put some decent bearish exposure on the stock market. Of course, usually it's something to do with options or options on futures or options on equities, but yeah, so limited risk, but still I thought, okay, then I will put some decent bearish exposure, but no. Now I'm still in the day trading camp. By the way, Raphael, welcome to the day trading camp. It's the best camp to be in. But yeah, basically that's what, and for now it didn't happen. Of course, we all see this price action and what's going on. We all see that. I mean, it can change tomorrow. It can change just like that. But yeah, first level is the December settlement level to the downside. And for me, close matters. Intraday, I would try to trade breaks, but it doesn't mean that it matters for the longer period. What means intraday, yeah, if we go below 58.40, of course, I will open short positions, but it's more of a day trade. If it closes below 58.40, then it's not a day trade anymore. It's actually a very bearish signal. Just to remind and to form a habit of knowing these levels and writing those levels down, I will say that September, so below 2024, we have 57 even, which is ESU contract, which is of course September contract, and it settled 57 even. What a beautiful number. So it would not be very nice news for equity bulls, but of course we have process and risk management and smaller, less important levels in between, but basically that would be a scenario. If we go below 58.40, that's the next major level, which of course would not be that fun for long-only investors. So now another important level is not settlement, but things like yearly open, quarterly open, and so on. So now we have yearly open. Yearly open was 59.49.25. I know that some people would round it up to 59.50. That's not what I do. Level is 59.49.25. And basically what it means that below that we are negative for a year, and doesn't matter that it's a beginning of a year. Year to date, it's bearish because markets are below its yearly open, so you can also use it as a pretty important level. And this level, big money will have to follow that level always, because if now let's say so second scenario. Market goes to upwards. So it will not go below 58.40. We are all saved. The market comes back to 59.49. Then ES will be green for a year. Green for a year, it means people with mandate have to chase it, and of course, retail people will also want to chase it, and so on. So it's also level of interest. So big level to the upside to watch is 59.49, and basically, if we close strong above that level and volatility comes down, I would easily see previous highs, or at least 6,100 or something like that. So yeah, now you can repeat all those levels with any futures contract you want, but now, of course, everyone is talking about tech. So I'll just very quickly tell you that NQ is not that different, and basically 29.48 was the settlement price of December contract. So how NQ is doing now? Yeah, it's below. So now we're back to that same scenario that we had months ago when we were talking down that ES basically after basically went all the way up, but NQ is lagging. Well, welcome to the same exact situation we have now. So this is another reason why I would not touch tech stocks on a long side now. There's no way. And it's not only because, of course, NQ is bearish trend and still closed as a bearish trend. No, it's because it's again, it's lower than that. So than that settlement price, which is that's how I basically think about the market. And the yearly open is pretty far also. 21,269 is the level to the upside to watch. Yeah, so correlations are always very important to watch, and yeah. So now what I expect is actually, as Raphael said, it's not a decent time to buy stocks. So what I want basically ES to confirm that it wants to go down, and then I'll add some bearish exposure. For now, I remain in day trading camp, and when it comes to dollar, I also see the same as Raphael sees. Of course, that's what I use. But basically, if we see what the Hearst exponents are doing, basically we can expect some correction in that dollar. But be careful. Be careful. It means that don't short the dollar. Just if you have long exposure, I would consider adding some hedges or selling some, basically reducing that exposure. I believe we have inauguration on 20th or something. So same situation can repeat itself. We had a very big move start after election, when election results were quite clear, and now inauguration can also be important factor to the dollar. Of course, I don't trade any narratives, news, or whatever. I trade what I see, but I just wanted to let you know that keep that in mind. Trend is very strong. Everything is very strong apart from Hearst exponent, but keep in mind that overall it's a currency, and it's a reserve currency, or maybe in Forex world, I would say G7 or G10, so not emerging market. I mean, so these currencies are not going up or down for very long times, long periods. I mean, Forex in the long run always trades around the mean. So just keep that in mind, that dollar is very strong, but it's not NASDAQ. So one day or another, it must stop. Otherwise, because when NASDAQ is going up, everyone is happy, unless you are, of course, shorting that. When a currency is going up, after some time, it will start to cause issues, and then we have all the interventions or something. So no, I don't expect any interventions. And in the beginning, at least in the beginning, Trump will love strong dollar. I'm sure about that. But keep that in mind. So yeah, my overall view is this: that actually we're at an interesting point, and let's see how it goes. But I wanted to give you these levels. And also I wanted to stress the importance of correlation, and especially average sector correlations. And yeah, when average sector correlations go to levels like 0.9 or so, you can expect something. And usually that something is the reverse of what happened, at least for a very short term, a couple of days or a week or so, but not always. Sometimes the correction in the correlation has no impact on overall direction of the entire market. Usually it just impacts that some sectors will correct itself, and then the picture is looking good again. So like I said, you can use correlation alone just to have some directional opinion. Oh, now market will go up or down, but you can use correlation to say, okay, so now it's not normal and something will change. And good news is that it's not something may change. When correlations go to 0.9 and 0.95 and these extreme levels, it's not may, it will, but of course manage your risk. Yeah, so that's it from me. But like I said, I'm quite excited because I see quite a few things building up, and of course now the main question is whether it will happen or the signals will reverse. Yes, that's it.
Yeah, also I forgot to show the MFR signal for going into tomorrow. Sorry, but the upside downside ratio, they are very, very high, and you have implied volatility premium, like huge, going into tomorrow. So definitely not a setup to go short.
Oh yeah, but two things about implied volatility premium. Yeah, and it will only apply to premium because I trade a lot of options. It's one of my main tools. So I use implied volatility a lot. But one thing is that I never found premium itself as a very reliable indicator. A lot of people are using it, and we had a lot of requests. So of course it's there, and it's useful in some way, but I think that our tools available like rank percentile and some other tools are at least in my process way more important. But the second thing about premium, well, tomorrow we have quite an important news release, so
exactly, yeah.
That can also be a reason. Yeah, upside downside ratios are insane. Well, not insane, but as you said, high. They can be way higher. But another thing is also, like I said, you need to watch the overall action, because now in these levels, that's why I tweeted a couple of days ago that, hey, if you don't know what the level is, you should write it down because it's important. Yeah, and nothing changed. For now, it's not a short. It's definitely not a short because market tried to go down, it failed. So with this news release, what I expect tomorrow, yeah, now I will sound like a furu because just because of that release, yeah, I expect market to go up or down. Yeah, basically, do with this information what you want. I expect market to go up or down. But I expect these news releases that we have this week give us some clues to which direction it wants. And I'm not talking about intraday chop after CPI or something, but will, for example, after CPI, will market close below that important level, or will market go back to that yearly open or something like that? And for me, it's the most important information I need to know. So yeah, but yeah, maybe I can start a forex trading journal, YouTube channel. I mean, tomorrow I expect market to go up or down. But yeah, and
we said embrace the chop. It's a theme. So
I know, yeah, but yeah, of course, very agree, and not only because of IV or important news releases. but because of the area where we are in the market, because it's very important area, and as always, news releases will help market to go either below this important area or above this important area, and then from my process, and then I will know what to do, and that's when I usually trade. I'm not talking about day trade. I talk about some portfolio exposures. I only trade when I see, of course, managing risk and something, but other important things. But I only trade when I say, okay, so we failed to close below 58.40, and now we are back to yearly open. As an example, simple example. Oh, okay, cool. So now bullish exposure. Yeah, and yes. I don't try to catch tops or bottoms. Yes, if market goes back to yearly open, it means market will go back 140 points. And yes, I will miss those entire 140 points, and I will be very happy to miss them. That's how I trade. Yeah, but good points, very good points. And I'm really excited about action during the news releases and what tomorrow will bring.
Okay, let me check if we have a question in the chat. Nothing in the chat. Going quickly to Twitter, but I think we will.
Yeah, I think it was quite an interesting conversation. I hope it was also useful to our viewers as well.
Yeah, it's gonna be easier to do predictions after tomorrow.
No, I would say after inauguration, but it's the same thing.
We have to get the news
It's the same
cycle
thing.
out of the way. I mean,
Yeah.
I see so many guys on Twitter, they're like very high conviction, the same conviction they had about the Santa rally. And now they have very, very high conviction as well, and I'm like,
Yeah, if on January 20th in the evening US invades Canada, at least we'll know what to do.
Exactly.
No, of course, it was not the best joke, or maybe too hard.
Greenland.
Well, Canada is
The same deal. Something
yeah. Well,
is Greenland bullish stock market? I'm pretty sure there's some guy doing a video about it.
Yeah, of course.
Anyway.
All right.
So let's see tomorrow.
Yeah. So thanks everyone. Thanks Ted, Raphael. Thanks everyone watching, and as always, I hope it was useful, and see you hopefully in 2 weeks. We'll see, but I'm sure that next time we will have some answers and clarity in the market. Whichever direction it is, but we will have.
I have a live show on the 20th, so I'm gonna open. It's gonna be on YouTube. I'm gonna put a link for the Zoom so that the people can join and ask questions about the trade and trend volatility script. Because I'm receiving more and more questions, and it's usually the same kind of questions. So I'm going to do a live show. If you can join, just come, ask questions about how to use, etc. And if not, you can just rewatch it later.
Awesome.
Take care, guys.
All right, guys. Good night.
Bye, everyone. Take care.